What if the life insurance policy you're paying for today ends up doing absolutely nothing for your family tomorrow? What if the money you think you're saving is actually being burned slowly every month and you don't even know it? Term versus whole life insurance might sound like a boring adult decision, but choosing the wrong one could literally cost you tens of thousands of dollars and leave your loved ones in a mess. Stick around, because by the end of this video, you'll know exactly which one fits your lifestyle, budget, and long-term goals. And there's one hidden detail that most people overlook, one that could make or break your entire plan. Let's dig in. Number 1. What is term life insurance really? Term life insurance is like renting your coverage. You pay for it only for a certain period, usually 10, 20, or 30 years. If you die during that time, the policy pays out to your family. If you outlive it, the policy ends, and you get nothing back. It's cheap, it's simple, and it does one job: protect your family if you die young. Let's say you're 30 years old with a spouse, 2 kids, and a mortgage. A 20-year term policy for $500,000 might cost you just $25 a month. That's powerful peace of mind for a pizza night budget. But here's the kicker: it builds no cash value. Once the term ends, it's like the coverage never existed. Number 2. What is whole life insurance? Whole life is like buying your coverage and keeping it forever. You're covered until the day you die, no matter how old you get. And here's the twist: it also builds cash value over time. Think of it like a savings account built inside your insurance. Part of your premium goes toward coverage, and part of it grows slowly with interest. Eventually, you can even borrow against it or cash it out, but it's expensive. That same $500,000 policy that costs $25 a month for term, it might cost $300 or more for whole life. Big difference, right? So why would anyone choose whole life? Let's explore. Number 3. Why is term insurance so popular? The biggest reason: it's affordable. Most people need insurance when they're young, when they're raising kids, paying off a home, or building a career. A term policy gives you high coverage for low cost during the years your family needs it most. It's like a safety net while you're climbing the financial ladder. Let's say you're a new dad with a tight budget. You get a 20-year term policy to protect your wife and kids. By the time it expires, your kids are grown, the house is nearly paid off, and your investments have grown. You don't need insurance anymore. Term life is like training wheels. It helps you balance when you're still getting started. Number 4. Why do some people choose whole life? Whole life isn't about covering your temporary needs. It's about leaving a legacy. If you have long-term goals, like funding a trust for your grandkids or covering estate taxes, whole life gives guaranteed lifetime coverage. Also, the cash value acts like a forced savings plan. Some people use it as an emergency fund, or even as a way to borrow money later in life. Example: a 45-year-old dentist buys whole life. She pays $400 a month, but by retirement, she's built up over $100,000 in cash value. She can now take a loan from her policy to help fund her retirement, without needing to go to the bank. It's not fast growth like a stock market investment, but it's steady, and it's there when she needs it. Number 5. Let's talk cost. Why is whole life so expensive? Whole life insurance costs more because it does more. It offers lifelong coverage and builds cash value. It's kind of like buying a home instead of renting. Yes, it's more expensive up front, but you're building equity over time. But not everyone needs to own their insurance. If your only goal is to protect your family during your working years, paying more might not make sense. Here's a breakdown. Term life: $30 a month for $500,000 coverage. Whole life: $300 a month for the same amount. Over 20 years, that's a difference of over $60,000. Imagine what you could do with that money. Invest it, save for college, pay off debt. Number 6. What happens when the term ends? This is where people get caught off guard. Your term policy ends. You're still alive. And now, you have no coverage. If you want to renew, it'll be super expensive. Why? Because you're older now and possibly less healthy. Let's say you got a term policy at 30. Now you're 50 and the term ends. Getting a new policy at 50 might cost $200 or more for the same coverage you had at 30. That's why some people buy a longer term or add a conversion option to switch to whole life later without a health exam. But if you plan your finances right, you won't need insurance at 50. You'll be self-insured with savings and investments. Number 7. Cash value. Is it worth it? Let's clear up a common myth. The cash value in whole life sounds attractive, but it grows slowly. We're talking maybe 2 to 4% per year. Compare that to an index fund that averages 7 to 10%. So if you're buying whole life just for the investment, there are better ways to grow your money. However, cash value does have benefits. It's safe, guaranteed, and not tied to the stock market. It also grows tax-free and can be accessed without triggering taxes if done correctly. For high-income folks who've maxed out their 401k and IRA, this can be an extra tax shelter. But again, if you're living paycheck to paycheck, this is probably not your top priority. Number 8. The hidden trap: mixing insurance and investing. Here's where things get tricky. Insurance companies love to market whole life as protection and savings in 1 inch. Sounds convenient, right? But when you mix insurance and investing, you often get less of both. You're paying more for slower growth and coverage you might not even need long-term. Let's say you split the cost. You buy term life for $30 a month. You invest the remaining $270 per month into an index fund. In 20 years, your term ends, but your investments could be worth over $150,000. That gives you freedom, flexibility, and control. It's called buy term and invest the difference. And it's a popular strategy for a reason. Number 9. When whole life actually makes sense. There are situations where whole life is the smart move. If you have lifelong dependents, like a child with special needs, you want permanent coverage. If you're ultra-wealthy and want to minimize estate taxes, whole life can help. If you want to fund a trust or leave money behind no matter when you die, it's the way to go. Also, some business owners use it as a financial tool to secure loans or build wealth inside the business. But for most middle-income families, term is usually the smarter play, at least until you've built wealth on your own. Number 10. Which one should you choose? It comes down to your goals. If you want affordable, temporary protection, term is the clear winner. If you want guaranteed coverage for life and don't mind the cost, whole life might fit. Ask yourself, do I need insurance forever or just until my kids are grown? Do I want to build wealth through my policy or invest separately? Do I have a financial cushion or am I still getting started? If you're still unsure, start with term. It gives you flexibility. You can always convert later or supplement with whole life if your situation changes. But buying the wrong policy now, that's a mistake that could haunt your finances for decades. Number 11. What about convertible term policies? A convertible term policy gives you the option to switch to a whole life policy later, without taking a new medical exam. This is helpful if you're not sure what your future health or finances will look like. Let's say you're 28, healthy, and buy a 20-year term policy. When you turn 35 and your income increases, you might want permanent coverage. Instead of applying for new whole life insurance and going through a health check, you can convert your existing term policy. It'll be more expensive than term, but you lock in the policy without worrying about your health status. This is a good safety net if you're unsure what the future holds. Number 12. Riders. Do you need them? Riders are add-ons to your life insurance policy. They give you extra features for extra cost. One popular rider is the accelerated death benefit. It lets you access part of your payout early if you're diagnosed with a terminal illness. Another common one is the waiver of premium rider. If you become disabled and can't work, your premiums are waived, but your policy stays active. Riders can add flexibility, but they also add cost. Think carefully about what you need before adding them. Example: a single parent might benefit from a child term rider, which offers small coverage for their child under the same plan. Number 13. Can you cancel a policy later? Yes, and that's actually more common than you might think. With term life, you can stop paying anytime. You lose coverage, but there are no penalties. Whole life is different. If you cancel early, you may get some of the cash value back, but often much less than what you paid in. It's not designed to be a short-term plan, and canceling too soon can result in fees, penalties, or just plain regret. If you think your needs might change, consider starting small or sticking with term. Number 14. What if you have coverage through work? Many employers offer group life insurance. It's usually 1 or 2 times your annual salary, and it's often free or cheap. Sounds great, right? But here's the issue. It usually ends when you leave your job. Plus, the coverage amount often isn't enough. If you make $60,000 a year, a policy worth $120,000 won't cover your mortgage, college costs, and funeral expenses. Group insurance is a nice perk, but it shouldn't be your only plan. Buy personal coverage that stays with you no matter where you work. Number 15. What do financial experts recommend? Most financial advisors recommend term life insurance for the average American family. Why? Because it does the job of protecting your family at the lowest cost, so you can use the rest of your money to invest and build wealth. Dave Ramsey, for example, is famous for saying, buy term and invest the difference. Other experts argue that whole life makes sense if you want a conservative, long-term financial tool and don't want to worry about market risk. The key is, don't just rely on what someone says online. Look at your own numbers. What are your goals? What's your budget? How long do you need coverage? There's no one-size-fits-all. Number 16. How to choose the right coverage amount. Whether you choose term or whole life, the amount of coverage matters. A good rule of thumb is 10 to 15 times your annual income. So if you make $50,000 a year, aim for $500,000 to $750,000 in coverage. This amount can help cover funeral expenses, debt, mortgage, and provide income replacement for your family. Also consider future needs like college tuition or medical bills. You don't want to guess here. Run the numbers. Online calculators can help, or you can speak with a licensed insurance agent. But don't underinsure just to save a few dollars a month. Your family's future is worth more than that. So now the big question, do you want insurance to protect your life or to build your legacy? Because that choice will guide everything else. Which one do you think fits your goals better, term or whole life? Let me know in the comments.